So the One Big Beautiful Bill is now officially law with over 900 pages that could completely change your taxes, your benefits, and honestly, your entire financial future. And here's the thing, most people will never read a single page of it, but I actually did. And what I found inside is going to blow your mind. Some of these changes could save you thousands of dollars. Others, well, they might hit you where it hurts most. And there's one provision buried deep in this bill that could affect every single American watching this video, but almost nobody's talking about it yet. I'm going to break down exactly what's in this massive piece of legislation, how it affects your wallet, and most importantly, what you need to do right now to prepare. Because whether you love it or hate it, this bill is here and the changes are starting. If we haven't met yet, I'm Sean's clone, a tax professional who personally researches and writes every script you see on this channel. And if you have any questions, the real Sean reads every single comment and tries to respond to most. Also, if you get any value from this, please click the like button for the YouTube algorithm, as it helps other people like you find this crucial information. Because One Big Beautiful Bill Act just became law on July 4th, 2025. And let me tell you, this isn't just another piece of legislation that gets buried in bureaucracy. This thing is massive, covering everything from your income taxes to student loans, from Medicaid to immigration, and even how much you'll pay for groceries. The mainstream media is focusing on the political drama.
This is not a big, beautiful bill at all. That is why I moved on the floor to strike the title. It is now called the Act.
But I'm going to focus on what actually matters to you, the money. Because buried in these 900 pages are changes that could either put thousands of dollars back in your pocket or cost you big time. But here's what's really interesting. There's a completely new type of savings account being created that could benefit millions of Americans. But there's a catch that most people won't see coming. Let's get started with Chapter 1, the individual tax changes that actually matter. Right off the bat, I need to tell you about 3 major changes that will impact every individual, affecting paychecks right now. First up, if you earn tips, whether you're a server, bartender, hairstylist, or work in any service industry, those tips are now tax deductible up to $25,000 through 2028. This became effective immediately when the bill was signed. So if you're filing taxes for income earned after July 4th, 2025, your tips are exempt. Now, this sounds amazing on the surface, but here's the catch nobody's talking about. The IRS is still figuring out how to enforce this without people gaming the system. Think about it. If tips become tax-free, what's stopping every business from restructuring their pay as tips? The bill includes guardrails, but implementing this is going to require hundreds of pages of new IRS guidance that's still being written. Moving on to overtime pay. If you're an hourly worker putting in more than 40 hours a week, that overtime premium isn't being taxed either. However, there are income caps that limit who actually benefits from this. If your regular wages plus overtime push you above certain thresholds, you might not get the full break. And here's another important update for individuals. Car loan interest is now tax deductible up to $10,000. If you're financing a vehicle, you can write off that interest on your taxes. But before you get too excited, this doesn't apply to luxury vehicles over $80,000, and you have to choose between this deduction and others when you file. There have also been changes to the standard deduction and senior deductions for 2025. That's $15,000 for single filers and $30,000 for married couples filing jointly. This is huge because it means most people won't need to itemize their deductions. But here's where it gets interesting for seniors. There's a new temporary senior deduction that's active right now through 2029. If you're 65 or older, you get an additional $6,000 deduction on top of the standard deduction. However, this phases out at higher income levels, starting at $200,000 for single filers and $400,000 for married couples. So wealthy retirees won't benefit as much. Now let's discuss the tax changes for entrepreneurs in Chapter 2, the business owner impact. The changes for business owners in this bill are honestly some of the most generous I've ever seen. We got an enhanced pass-through deduction. This is a 20% deduction for pass-through business income, that's LLCs, S corporations, partnerships, and sole proprietorships. This isn't just being made permanent, it's getting supercharged. The deduction is now 20% permanently for most business owners, and the income limits have been raised significantly. Here's what this means in real numbers. If you have a successful consulting business making $200,000 in profit, you can now deduct $40,000 right off the top. That's a $40,000 reduction in your taxable income, which could save you about $8,000 to $15,000 in taxes depending on your bracket. But here's the kicker. The phase-out thresholds have been increased. For 2025, single filers can earn up to $191,050 and married couples up to $382,100 before the deduction starts phasing out. Previously, these limits were much lower, so more business owners can now take advantage of the full deduction. Plus, bonus depreciation is returning. You can now deduct 100% of the entire cost of business equipment in the year you buy it. This is called full expensing, or bonus depreciation. Let me give you some examples of what this means. If you're a content creator and you buy $15,000 worth of camera equipment, computers, and studio gear, you can write off the entire $15,000 immediately. That could save you $3,000 to $5,000 in taxes right now. Or if you're a contractor and you buy a $75,000 work truck, the entire cost is deductible in year one. For someone in higher tax brackets, that could be $20,000 or more in tax savings. On top of that, Section 179 was enhanced. The limit has been permanently increased to $2.5 million for 2025 with a phase-out threshold of $4 million. This means smaller businesses can write off even more equipment purchases immediately. But here's what's really interesting. The definition of qualifying property has been expanded. Certain building improvements, HVAC systems, and even some software now qualify for immediate expensing under Section 179. Research and development expenses. Here's something that's flying under the radar but is huge for certain businesses. Research and development costs can now be fully expensed in the year they're incurred, and this is permanent. This doesn't just apply to tech companies. If you're developing new products, creating software, testing new processes, or even developing new marketing strategies that qualify as R&D, those costs can be immediately deducted. For a small software company spending $100,000 on development, that's a $100,000 deduction that could save $25,000 to $37,000 in taxes. Business interest deduction improvements. The limitation on business interest deductions has been permanently modified. Previously, you could only deduct business interest up to 30% of your adjusted taxable income. Now, that's been increased to 50%, and the calculation method has been improved to be more favorable to businesses. For businesses with significant debt or equipment financing, this could free up substantial additional deductions. As a tax professional, I love seeing some of these updates as it will provide small business owners with real tax savings. And if you own a business and need help creating a tax plan around these new tax laws, click the first link in the description below. Moving on to something that's creating entirely new opportunities for families. Chapter 3, the Trump accounts, a new way to build wealth. Now we get to one of the most innovative parts of this bill, the creation of Trump accounts. And before you roll your eyes at the political name, hear me out, because this could actually be a game changer for families with young children. Here's the deal. For every child born between 2025 and 2029, the government automatically deposits $1,000 into a special investment account. But that's just the beginning. Families can contribute up to $5,000 per year to these accounts, and the money grows completely tax-free. When the child turns 18, they can withdraw money for qualified expenses like education, starting a business, or buying a home, and they pay capital gains tax rates instead of ordinary income tax rates. But here's the kicker. At age 30, they get full access to the account with no restrictions and no penalties. Let's run some numbers. The government deposits $1,000 when your child is born. If you add just $2,000 per year for 18 years and the account grows at 7% annually, here's what happens. Government contribution, $1,000. Your contributions, $36,000 over 18 years. Total invested $37,000 account value at 18, approximately $89,000 account value at 30 if left untouched, approximately $218,000. That's over $200,000 from a $37,000 investment, all growing tax-free. Even if your child uses half for college, they'd still have over $100,000 for their future. But let's look at the investment options. Because unlike other government programs, Trump accounts offer real investment choices. You can invest in stock index funds, bond funds, target date funds, and even individual stocks. The account providers include major financial institutions like Fidelity, Vanguard, and Charles Schwab. The fees are capped at 0.5% annually, which is incredibly low for government-sponsored accounts. For comparison, many 529 plans charge 1 to 2% in fees. But there's a catch you need to know, and this is where it gets complicated. There are income limits for who qualifies for the government contribution. If your household income exceeds $150,000 for single filers or $300,000 for married couples, you don't get the initial $1,000 deposit. But you can still open the account and make your own contributions. Also, if you withdraw money before age 18 for non-qualified expenses, you pay ordinary income tax plus a 10% penalty. And the definition of qualified expenses is pretty strict. It's not as broad as 529 plan rules. But for now, let's move on to Chapter 4, the SNAP and Medicaid changes. Now we need to talk about changes to government benefits, because this is where the bill gets controversial and could directly impact millions of Americans. There has been a major change to the food stamp program. The government's official food benchmark, called the Thrifty Food Plan, has been essentially frozen. This plan determines how much food assistance families receive, and under this bill, it can only be adjusted for inflation, not for changing nutrition science or eating habits. What this means in practice is that if healthy foods get more expensive relative to processed foods, or if nutritional guidelines change, benefit levels won't keep up. The plan stays locked unless the USDA does a full reevaluation, which they can't even consider until 2027. And even then, they can't increase the overall cost. Work requirements. The bigger change is to work requirements, which are being enforced much more strictly now. If you're between 18 and 65, able-bodied, and not working at least 80 hours a month or enrolled in training, you risk losing benefits. The exemptions are pretty limited. You have to be pregnant, caring for a child under 14, medically unfit for work, or a member of a federally recognized tribe. State waiver limits. States have lost most of their ability to waive these requirements during tough economic times. Alaska and Hawaii get some flexibility, but only until 2028, and they have to submit quarterly reports proving they're making progress. Medicaid work requirements and cost sharing. Now let's talk about Medicaid, because these changes are even more significant and are being phased in over the next few years. States must implement community engagement requirements, basically work requirements for certain adults to maintain coverage. If you're an adult without dependents or disabilities, you'll need to work, volunteer, or participate in approved activities to keep your health care. But here's the kicker. States are also getting new cost-sharing requirements tied to how accurately they manage their payments. If a state has too many errors in processing, they lose federal funding. This creates an incentive for states to be extra strict on verification, which could mean longer wait times and more paperwork for people applying. And starting in 2027, the federal government is cutting its share of administrative costs from 50% to 25%. So states have to find more funding on their own to keep these programs running, which could lead to fewer staff, more backlogs, or slower service. But it gets worse with Chapter 5, the student loan bombshell. If you're in college, planning to go to college, or paying off student loans, this next section is crucial because it completely changes the game for higher education financing starting in July 2026. Here's the big change. Starting July 2026, academic graduate students can only borrow $20,500 per year in federal loans, with a lifetime cap of $50,000 total. This is a massive shift from the current system where you can borrow up to the full cost of attendance. Let me put this in perspective. For public, in-state students at a four-year institution, the average cost is around $29,910 per year. This means students will either need to come up with the rest out of pocket, turn to private loans with higher interest rates and fewer protections, or choose less expensive programs. We also have loan forgiveness changes. Public service loan forgiveness and other income-driven repayment plans aren't being eliminated, but they're being narrowed significantly. Fewer types of jobs will qualify. The definition of public service is being tightened to exclude some nonprofit organizations and government contractors. The terms for forgiveness are also taking longer to reach. Some income-driven plans now require 25 years of payments instead of 20 before forgiveness kicks in. But here's a bright spot. We now have expanded Pell Grants. This bill expands Pell Grant eligibility for short-term credentialing programs, things like coding boot camps, nursing certifications, skilled trades training, and even some online certificate programs can now qualify for federal aid. Now, let's jump into Chapter 6, the immigration and border provisions. Now we're getting into the part of the bill that's generating the most political heat, but I'm going to focus on the practical implications rather than the politics, starting with border security funding, because the bill allocated significant new funding for border wall construction with specific language requiring the Secretary of Homeland Security to resume building. What's different this time is that it limits the power of future administrations to cancel or reprogram that funding. It's locked in legislatively. There is more funding for agencies. Border Patrol and ICE received major funding boosts for hiring thousands of new agents, buying surveillance technology, and expanding detention capacity. This means more officers on the ground and more facilities to hold people awaiting immigration decisions. Plus, there has been fee increases and more work authorization required. Various immigration fees have gone up to fund enforcement. If you're applying for a work visa, green card, or adjustment of status, you're paying more under these new rules. Some fees have doubled or tripled. There's also a pause on work authorization for certain asylum seekers, meaning people have to wait longer before they're legally allowed to work while their case is being processed. This puts financial pressure on applicants and may deter some from filing in the first place. Moving on to something that affects the energy sector and could impact your utility bills. Chapter 7, the Energy Policy Reversal. This section represents a major policy shift in how the government approaches energy and climate investment, and it's already affecting everything from your electric bill to your next car purchase. We're seeing a ton of clean energy credit rollbacks. The bill terminated most of the clean energy tax credits that were put in place over the last few years, and many of these terminations happened immediately. The electric vehicle EV tax credit, gone as of September 30th, 2025. Credits for solar panels and home energy improvements, mostly eliminated. Commercial clean vehicle credits and EV charging station credits, also gone. If you were planning to buy an electric car and get money back at tax time, that window has already closed. Same goes for home solar installations or energy efficient upgrades. Those federal incentives have disappeared. At the same time, there has been a shift to traditional energy, as the bill expands tax breaks for fossil fuel producers. Clean fuel production credits are being modified to include biofuels and natural gas derivatives. There are new deductions for drilling and development costs, which oil companies can write off faster. So what does this mean for the average American? In the short term, this has slowed the adoption of electric vehicles and renewable energy as the financial incentives disappeared. But it might also lead to lower traditional energy costs if increased domestic production brings down prices. Chapter 8, what this means for your money. Alright, so we've covered a lot of ground here. Let me break down what all of this actually means for different groups of people and what you should be doing right now. If you're a service worker, the tax deduction for tips provision is already in effect and could be huge for you, but keep tracking your tips the same way you always have. The IRS is still releasing guidance on how this works in practice, and you want to be ready for any audits or questions. Remember, this provision expires after 2028, so don't make long-term financial plans assuming it's permanent. If you're a business owner, this is where the biggest opportunities are right now. The enhanced pass-through deduction and full expensing for equipment could save you tens of thousands of dollars. If you've been putting off buying business equipment, now is the time to do it, since you can write off the full cost immediately. That $50,000 piece of equipment you've been considering, you can deduct the entire cost this year. If you have young children, the Trump accounts could provide a real head start for kids born between now and 2029. While $1,000 isn't life-changing by itself, combined with regular contributions, it could grow into substantial wealth over 18 to 30 years. The key is starting early and being consistent with contributions. Even $100 per month could turn into significant money over time. If you're planning graduate school, this is where you need to pay serious attention. The borrowing cap changes in July 2026 and could completely change your education financing strategy. If you're looking at expensive programs, start exploring private loan options now and understand the terms. Also, look into those expanded Pell Grant programs for shorter term credentials. Sometimes a 6-month certification program can be more valuable than a 2-year master's degree, especially if it's federally funded. If you're on government benefits, the SNAP and Medicaid changes are requiring more documentation and potentially more work requirements. Make sure you understand what's required in your state and start preparing now. Keep better records of your work hours, training programs, and any qualifying activities. Chapter 9, the unintended consequences nobody sees coming. Here's what I found really interesting while reading through this bill. There are some major unintended consequences that most people haven't thought about yet. The bill is expected to widen the federal deficit by trillions of dollars over the next decade. For example, one estimate from the Congressional Budget Office projects an increase of $3.8 trillion over the 2026 to 2034 period, according to CNN, which makes sense. Less tax revenue and more spending create a deficit. This is something many people are already talking about, but what they aren't sharing is how the bill may create a budget crisis at the state level as well. Remember how I mentioned that states are losing federal support for administering SNAP and Medicaid? This is creating budget crunches at the state level. States will either have to raise taxes, cut services, or find creative ways to maintain these programs with less federal help. This is leading to a patchwork system where benefits and services vary dramatically from state to state, much more than they do now. We're essentially seeing the creation of benefit havens and benefit deserts based on state policy choices. Plus, the service industry is restructuring. The no tax on tips provision is creating some weird incentives. We're seeing businesses trying to restructure compensation as tips to take advantage of the tax break. Hair salons are implementing tip pools, consulting firms are calling bonuses gratuities, and even some tech companies are experimenting with tip-based compensation. The IRS is scrambling to write rules to prevent abuse, but it's like playing whack-a-mole with creative accountants. Then there's a huge clean energy investment shift because with federal incentives gone, clean energy investment is shifting to states and private markets. States with strong renewable energy policies are seeing an influx of investment while others are falling behind. This is creating regional energy cost disparities that we haven't seen before. Some states are becoming clean energy hubs with lower electricity costs, while others are becoming more dependent on traditional energy sources. This is growing the divide between the now and the future. Chapter 11. The implementation timeline. Let me walk you through when these changes actually take effect, because timing is everything when it comes to tax and financial planning. Already in effect as of July 4th, 2025. Tax changes on tips, overtime, and car loan interest through 2028. Senior deduction, $6,000 for age 65 and older through 2029. Immigration and border security provisions. Trump accounts for eligible children, enhanced business expensing as of January 19th, 2025. In 2026, we'll see enhanced pass-through deduction, new standard deduction amounts. Some Medicaid work requirements begin phasing in, and then in 2027, we'll see full implementation of Medicaid work requirements. First possible reevaluation of SNAP benefit calculations, then in 2028. Tips and overtime tax exemptions expire unless renewed, then in 2029. The senior deduction expires unless renewed, and it's the last year for Trump account government contributions. Finally, in 2030 and beyond. Many provisions automatically expire unless renewed by Congress. Chapter 12, your action plan. All right, so what do you actually need to do with all this information? Here's your step-by-step action plan. Immediate actions for the next 30 days. First, if you're a business owner, start planning major asset purchases for this year. The full expense benefit is already in effect, so that $25,000 computer system or $75,000 piece of machinery can be fully deducted this year. Second, if you have children or are planning to have children, research Trump account providers and understand the investment options. The sooner you start, the more time your money has to grow. Third, if you're earning tips or overtime, start documenting everything carefully. While these are tax-free now, you want to be prepared for any IRS questions or audit within the next 6 to 12 months. If you're planning graduate school and it starts after July 2026, completely reassess your financing strategy. The $20,500 annual cap changes everything. Look into private loan options, employer tuition assistance, and alternative credential programs. For business owners, this is the time to consider entity structure changes. The enhanced pass-through deduction might make an S-Corp election more attractive, but get professional advice before making changes. If you're on government benefits, start documenting everything more carefully: work hours, training programs, medical conditions, whatever might be relevant to maintaining eligibility under the new rules. Long-term planning for the next 1 to 5 years. Think about how these changes affect your overall financial plan. If you're in a high tax state, the continued SALT deduction limits might influence where you choose to live or work. For parents, consider how the education financing changes might affect your college savings strategy. 529 plans are still valuable, but you might want to diversify your approach to include shorter terms credential programs. Business owners should think about how inflation may affect their costs and consider hedging strategies if price volatility begins. Of course, given the complexity of these changes, this might be the year to invest in professional tax and financial planning help. Click the link down in the description below if you want assistance. Because look, the One Big Beautiful Bill is a massive piece of legislation that's already touching almost every aspect of American life. The key is understanding how these changes affect your specific situation and acting accordingly. And most importantly, stay informed. This bill is just the beginning. There will be implementation guidance, court challenges, and probably additional legislation that modifies some of these provisions. The IRS is still writing hundreds of pages of guidance on how these new rules actually work in practice. I'll be covering as much as I can on this channel, so make sure you subscribe, and I'll see you in the next video.